Hello class, this is Dr. Fenton. In this video, we're going to cover Chapter 5, which deals with cost-volume-profit relationships. Now one thing before we get started, these slides total 49, and that's a lot more than I usually like to use, but I did cut out over half of the ones that the publisher first sent, and these are the ones I think are the most relevant. A lot of these slides tied together, they follow the same example through, so it won't be as bad as it might seem. So let's get started. We're going to talk about cost, volume, profit analysis, and before we do that, let's cover some key assumptions. First of all, the selling price is constant. So in all of our examples, no matter how many units we sell, we assume that the selling price will be constant unless we change the selling price on purpose. Number two, costs are linear and can be accurately divided into variable cost and fixed cost components. Let's look at this. We have an example called the Racing Bicycle Company. This is a contribution income statement. Now this is similar to the one that we saw in Chapter 1 of the book, where we show the revenue, in this case sales, and then we show variable expenses taken away. That gives us something called contribution margin. Then we'll take away fixed expenses, and that will give us net operating income. So again, the contribution margin is the amount remaining from sales, the sales revenue, after variable expenses have been deducted. Contribution margin is used first to cover fixed expenses. Any remaining contribution margin contributes to net operating income. So again, contribution margin is just simply your sales revenue minus your variable expenses. That's contribution margin. In this income statement, we see the company selling 500 bicycles, and the per unit amount is $500 per bike. Variable expenses, $150,000 total, but $300 per unit, and the contribution margin with $100,000 total, and a per unit amount will be $200. So for every bicycle that we sell, we have $200 per bicycle that is the contribution margin. And so if we take the $200 per bike times the 500 bicycles we're selling, that gives us $100,000 in contribution margin. Next we have fixed expenses. We subtract this away. In our example for most of these slides, the fixed expenses will be $80,000. Subtract that and our net operating income is $20,000. This is a slide showing us what the income statement would look like if we are selling at the break-even point. And of course the break-even point means if we sell exactly at this level, we don't have a loss, we don't have a profit, we have zero net operating income. So for this example, for the Racing Bicycle Company, the break-even point is 400 bicycles. That's $200,000 in total sales revenue, and that's at the rate of $500 per bike. And then you can see the variable expenses and then the contribution margin. In this case, the total contribution margin right here equals our fixed expenses. And when you subtract fixed expenses from contribution margin, then your net operating income is zero. Now, one thing we can do to use this contribution approach, this cost, volume, profit analysis, is tell what impact additional sales of the product or even fewer sales of the product have on the bottom line. So if we are selling at 401 bikes, that's one bicycle above the break-even point, then we should have $200 that'll be equal to our net operating income. Let me go back up a slide or two. Here's this slide, and we can see that we have zero profit when we sell 400 bicycles. So let's sell one more bicycle, and you can see that the revenue is going to change, the variable expenses will change, the contribution margin will go up $200, but the fixed expenses will stay the same. And you'll see $200 right here, and there it is. So if you sell one more bicycle above the break-even point, you have a little bit more revenue. You sold one bike, $500 more revenue. Variable expenses, $300 more. But $200 contribution margin hits the bottom line. So this is one good thing about the cost, volume, profit analysis. You can easily see the impact on the bottom line of selling more or fewer of the product. This slide further explains what I just talked about. Again, if you're at the 400 bicycle, in other words 400 unit break-even point level, if the company sells one more bike above the break-even point, then the net operating income will be $200. We just saw that on the previous slide and on this slide. So again, you're selling one bicycle above the break-even point, and so the contribution margin equals your net operating income. And this slide shows us that we can compute the bottom line, net profit or loss, at any level quite quickly. If you don't sell any units, then no revenue coming in, no variable cost, no contribution margin. You have to pay your fixed expenses, that's your loss. If you sell below the break-even point here, you'll have a loss because your contribution margin is not covering your fixed expenses. As we saw earlier, at the break-even point, our contribution margin has met and paid for the fixed expenses with nothing to spare, so we have zero profit or loss. And if we sell a lot more than the break-even point, we're up to 600 units, then our bottom line jumps up quite a bit. Let's look at a graph. Now, what we're going to do is plot units across the bottom and then dollars along the side. And so, the volume be the x-axis, units, and dollars, the y-axis. To plot the fixed expense line, then it doesn't matter at what level of units that we sell, it'll always be the same, in total. $80,000, say we are between 50 and 100, so $80,000 is your total fixed expenses, no matter how many units that you sell. If we plot the total cost line, what we do then is plot a variable cost line on top of the fixed cost line. So this is the slope of the variable cost, and that's at $300 per unit. And if we start here, then this is going to show us the fixed cost line. So we're putting the variable cost line on top of the fixed, and this will be the total cost line. They call it total expenses here, so that's fine, means the same thing. Now let's plot the revenue line. If we don't sell any units, then we don't have any revenue, but we still have to pay for the fixed cost. So we're losing $80,000. Then as we sell more units, the loss gets smaller and smaller until we hit the break-even point. So at 400 units, as we saw earlier, or $200,000 in sales, at this level, that's the break-even point. We don't have a loss and we don't have a profit yet. But as we start to sell more units, then our profit increases between the total cost line and the total revenue line. Here's a little bit better explanation. This is your loss area. So as you sell more units, your loss gets smaller and smaller. It's the distance between these two lines. Here's your break-even point. Above that, you have your profit area. Now let's introduce a new term, very similar to what we've been talking about. We're going to call it the contribution margin ratio. This is your contribution margin, in dollars divided by your total sales. And that represents what percent of each dollar goes towards contribution margin. So let's compute it for the RBC company. Here we go. If you remember at the break-even point, we had $80,000 in contribution margin. We had $200,000 in sales, so 40% is the contribution margin ratio. The two dollar signs cancel each other out, so we're left with a number out here. Your answer will be 0.4, but we'll call it 40% as your contribution margin ratio. So what this means again is for each $1 increase in sales, it results in a total contribution margin increase of 40 cents. You'll take 0.4 times $1 to get 40 cents. To use this, then what we'll do is take, the contribution margin ratio can be calculated by dividing the contribution margin per unit by the selling price per unit. So what this is doing is showing us a different way to compute the contribution margin ratio, and you can do it with just per unit amounts and get the same thing. So $200 contribution margin per unit divided by the selling price per unit. That gives us the same 40%. Now, if you take 40% away from 100%, you'll get what's called the variable expense ratio. And this can be computed directly. Take your total variable expenses, divide by your total sales, and you'll get 60%. So you have, two parts to the 100% selling price. Part of it is the contribution margin ratio, the 40% in this example, and the other part is the variable expense ratio, which is 60%. If we increase sales from our previous break-even point of 400 up to 500 bikes, a $50,000 increase, then we're going to have a bottom line increase of $20,000. You could set up the whole schedule like this to compute it, or you can quickly use the ratio we had earlier, take the increase in sales, the $50,000. We know that's going to be the contribution margin of 40% of that number, multiply, and so $20,000 is your increase in your net operating income. So two ways to compute this. Like I just said earlier, you can set the schedule up, go through all the numbers again, or quickly take the increase in sales times the contribution margin ratio, and you get the same number, $20,000. Another concept here, change in fixed cost in sales. Let's start changing things at this point. So we want to find out what is the profit impact if RBC can increase unit sales from 500 to 540 by increasing the monthly advertising budget to $10,000. So if we advertise more, spend more on advertising, and it does increase sales by 40 units, is that favorable? Let's look at the numbers. So you can see the sales bumped up from 500, we're already above break-even point, to 540. There's the sales. Contribution margin goes up $8,000, 100 to 108, but the fixed expenses went up $10,000. So overall, our net operating income went down $2,000. At first it looked great. Sales went up, $20,000. But since we had to pay more for fixed expenses to sell more units, we did not cover enough in the increase in contribution margin to cover the $10,000 extra we spent in fixed expenses. So $18,000 is lower than 20, so you might not want to do this. Here's a quick way to compute that. If we sell 40 more units and the contribution margin is $200 per unit, that's $8,000 is the increase in contribution margin. We increased advertising expenses $10,000, so in effect we lost $2,000 if we made this decision. So let me go back up a slide. You can compute it the long way like we did here, or once you know the contribution margin ratio and you know the increase in fixed expenses, you can compute it quickly like this. A much more concise schedule, but you get the same result. In other words, we lost $2,000 with this decision. Let's change something else. What is the profit impact if RBC can use higher quality raw materials, so it'll probably be a better product? It will increase our variable cost by $10 per unit, but it'll increase sales 80 bicycles, from 500 to 580. So if we spend more on the materials, make a better quality product, and increase sales, will this be a good decision for the bottom line? We bumped up sales 80 units. The price, the revenue jumps from 250 to 290. Your variable expenses, remember, we bumped up the expenses by $10 per unit. Back in the very first part, when we introduced the RBC company, the variable cost per unit was $300. Now it's $310. And 580, new number of units, our total variable cost, $179, drops into here. Our fixed cost did not change. Contribution margin goes up, and so our bottom line goes up. And since the fixed expenses did not change, then whatever increase we can have here on contribution margin, that will hit the bottom line. So you can see contribution margin went up $10,200. The bottom line went up $10,200 as well, because your fixed expenses did not change. So it would be wise to make this decision. Spend more on better materials. It does increase the variable cost, but it does bump up the contribution margin, and there was no increase in fixed expenses. So it does help our bottom line. Let's make another change. Let's cut the selling price to $20 per unit. And here's one of the assumptions I talked about at the very beginning, where we assume the selling price is the same. It is the same until we decide to change it. Same way with the variable expenses in the last example. Okay, so let's cut the selling price $20 per unit, increase advertising by $15,000, and that will increase sales from $500 to a nice jump to $650. So will this increase in the number of units that we sell more than offset the lowering of the price per unit and the increase in the advertising cost? Let's take a look. Here's where we were originally. Let's bump up the sales. The new selling price is down to $480, but $650 times $480 gives us $312. Take away the variable expenses. Our contribution margin goes up $17,000 up to $117. Our fixed expenses, $95, went up $15, and so we do go up $2,000 in profits because our contribution margin went up $17,000 and our fixed expenses went up only $15,000. So this would be a wise decision to, put $2,000 more in our bottom line. Here's another example. Again, what's the profit impact if we pay $15 sales commission per bicycle sold instead of paying the salesperson's flat salaries that currently total $6,000 per month? This was part of the fixed expenses. Sales increased from $500 to $575. I guess the salespeople are more motivated to sell if they get a commission for every bicycle they sell. So let's see what happens if we increase the number of units sold and we change the cost structure. Here's the original, and now sales go up to $287.5. Variable expenses increase because we did have $300 per unit variable expenses. The sales commissions now adds $15 more to that number, and so $575, the new number of units, times the new variable cost per unit, $181, $125. That leaves us $106,000 in contribution margin, so we're up there. Our fixed expenses lowered. We took $6,000 out of the fixed expenses down to $74. So not only did our contribution margin go up, but our fixed expenses went down, so it made even a better impact on the bottom line. So we're up to $32,375. We had a jump of $12,000, or $12,375 for this. So this is a very good decision here. Another example, and you can see with all these examples how easy it is to again see the impact of your bottom line using the cost volume profit analysis. That's where we separate the variable cost from the fixed cost. You don't see this in the regular income statement that you learned in Accounting 200. That's where we had the cost, in function areas, not the way they act, not variable and fixed, but were they cost of goods sold, were they, sell administrative and so forth. So let's see what happens here. We can sell 150 bikes to a wholesaler without disturbing sales to other customers. So we have the opportunity to go to a wholesaler, and usually we sell directly to people, but go to a wholesaler and sell 150 bikes. We would like, if we do this deal, we would like to increase monthly profits by $3,000. So this is a little bit different change than the other 4 examples. So we have the opportunity again to sell 150 bicycles, but we want to make, bottom line, $3,000. How can we make this happen? Let's take the $3,000 that we want in total in profits, 150 bicycles here. So it's $20 per bicycle we need to cover. Our variable costs are $300, and so we want to have $320 per bike to get covered. So this is the selling price required. If it costs us $300 to make, and we want to, have profit of $20 per bicycle, we have to sell the bike for $320. You might be thinking, well, wait a minute, the price was $500 earlier. Aren't we going to lose money? This is a special order. this has no impact on fixed cost. So fixed costs here are irrelevant in this decision. So if we sell the bikes 150 at $320 per bike, revenue's $48,000 in this special order sale. Variable cost total $45,000, and so we have $3,000 is the profit, and that's what we were after, $3,000. Now let's look at the formula method for computing the break-even analysis. And again, going back to the situation where we have this, we're above the break-even point. We know that because we have a profit down here of $20,000. But let's compute as if we did not know that yet, even though we do. What is the break-even point? What we're going to do to find break-even point in units, we're going to divide the fixed expenses, our total fixed cost, by the unit contribution margin. And so remember, $80,000 were the fixed expenses, $200 per bicycle was the contribution margin per unit, so our break-even point is 400 units. Now let's compute the dollar sales required to break even. In the previous slide, we calculated the break-even point in units, 400 units. Let's calculate the dollar amount, and let's use the formula method. So here we go. We take the fixed expenses in the numerator again, but in this case, in the denominator, we have the contribution margin ratio, not the contribution margin per unit. So we have, sorry for the misspelling down here. This was a graphic slide, and there's no way I could get in here and correct this. So just sort of ignore this for a second. They even misspelled this, so just ignore the spelling. Anyway, let's divide the fixed expenses by 40%, 0.4. That gives us dollar sales of $200,000. So your break-even point can be expressed in units, 400, or in dollar sales, $200,000. Sometimes we'd like to, often we'd like to go past the break-even point. We'd like to have some kind of profit. So if you're after a certain target amount of profit, there is a way to use the formula to determine how many units we have to sell to hit a certain target of profit. We do this by adding in the numerator the targeted profit to the fixed expenses. And if we divide that total by your contribution margin per unit, that's going to give us the sales we need to make in units to hit that target profit. We're past the break-even point and we have a profit. So if we would like to have $100,000 in profit, we add that to the break-even, to the fixed cost. So we have $180,000 in the numerator. Let's divide by the contribution margin per unit of 100. And so we have to have unit sales of 900 units. Not to break even, but to go way past that and have a profit of $100,000. So this is a quick way to find how many units we have to sell if we want to hit a certain targeted profit amount. We can also do this in sales dollars. What we'll do is take the $180,000 again in the numerator, divide by 40%, 0.4. That will give us dollar sales, again, misspelling here, dollar sales, $450,000. So to hit the target of $100,000 in profit, we can either, express it in units, 900, or dollar amount, $450,000 in sales. Now the margin of safety is just how far we are past the break-even point. And so if you want to express it in dollars, you take your total sales where you are now, subtract from that the break-even sales. So this is showing you how far past break-even point are you. That's the margin of safety in dollars. And you can see here is the margin of safety is $50,000. The break-even point is $200,000 in sales. And if we are at 500,000 units, $250,000 in revenue, you subtract these two numbers here, and we are at $50,000 of a margin of safety. That's how far we are past the break-even point in amount of sales. You can do this in number of bicycles also. If our margin of safety in sales is $50,000 and our bikes sell for $500 per bike, divide, and so we are 100 bicycles past the break-even point. So in sales, the margin of safety is $50,000. In units, the margin of safety is 100 bikes. Now the cost structure, sort of a little definition here. The cost structure refers to the relative proportion of fixed and variable cost in an organization. Managers often have some latitude in determining their organization's cost structure. Now this slide's a little bit busy. Let's just take a look at it. Companies have the choice of being, weighted more towards fixed cost or more towards variable cost. Both have good points and bad points. This talks about fixed cost. An advantage of high fixed cost, if you have that structure, is that income will be higher in good years compared to companies with lower proportion of fixed cost. So if you have a good year and you're past the break-even point, you've covered your fixed cost, that means the more you sell past your break-even point, the more you have going into contribution margin. That means the more you're having going to the bottom line. So you can do very, very well if you have a good year and you're past the break-even point. A disadvantage, though, is that income will be lower in bad years. So if you don't hit that break-even point, you're going to have losses because you have high fixed cost. And you got to get those covered. If you don't, you're going to have losses. And the last point here, companies with low fixed cost structures enjoy greater stability in income across good and bad years. All right, companies generally compensate salespeople by paying them either a commission based on sales or a salary plus sales commission. Now, commission-based sales on dollars can lead to lower profits in a company. Let's look at an example. Pipeline Unlimited produces 2 types of surfboards. Here, this is just a quick example. We don't have any slides much to back this up, just a very quick example. So 2 types of products, the XR7 and the Turbo. The XR7 sells for $100 and generates a contribution margin per unit of $25. Okay, not bad, $25. The Turbo sells for a higher dollar amount per unit, but the contribution margin is lower because your variable costs per unit are higher. And the sales force at Pipeline Unlimited is compensated based on sales commissions. So if you were a salesperson, which unit would you rather sell? The one with a selling price of $100 or the one with a sales price of $150? You'd want to sell the $150 because you'll get more sales commission. Let's say it was, 10% sales commission. You want to sell more of these. Will that help the company? No, because the company receives only $18 contribution margin per unit, for this one, the Turbo, whereas if the XR7 was sold, they would earn $25. So if you were, on the sales staff, just talked about this, you want to earn a higher commission. To eliminate this conflict, commissions can be based on contribution margin rather than on sales alone. So see what they're talking about here. Let's go back a slide. If you're compensated based on sales, you get 10% of your sales no matter which one you sell, you're going to sell this. You're the salesperson. You get higher commission. But if that's making the company lose sales on the XR7, the company's being hurt here because the company is only earning $18 contribution margin on this product compared to this one at $25. So they say to prevent this conflict, have the sales commission be based on contribution margin, and therefore salespeople will want to sell this one. Okay, so again, eliminates the conflict here, and maybe it can help you make better decisions. So I know these were a lot of slides. Here we are almost 30 minutes into the presentation. But anyway, this is the cost volume profit analysis. It's very helpful for managers within the company. It really focuses on selling price, variable cost, fixed cost, and contribution margin. It helps companies make better decisions, and you can calculate the numbers even quicker. So, hope you learned. Go back and review this if you need to. And again, as always, read the chapter in detail, and good luck with your studies.